In today's episode, I'll talk about two interesting stories. In the first story, I'll talk about SEBI's new rules regarding mutual funds and what it really means for the mutual fund industry, as well as people like you and me as investors. And in the second story, I'll talk about what exactly is happening beneath the surface when all the headlines are talking about Rupee being at an all-time low against the US dollar. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy to understand, yet one level deeper as compared to traditional news channels. I'm your host Anurag Bansal, and today is Tuesday, the 21st of January. The Securities and Exchange Board of India, or SEBI, recently announced a very important change in how mutual funds in India present their performance to investors like you and me. See, in a new circular, SEBI directed mutual fund companies to disclose a metric called the information ratio for all their equity-oriented schemes. Now, this measure will be updated every day on mutual fund websites, and it will also be available in machine-readable formats on the Association of Mutual Funds in India, or AMFI website. But the question here is, what does this exactly mean and why is it so important? Let's very quickly break it down. But first, in order to understand the significance of this move, I will need to explain to you what the information ratio exactly is and why SEBI wants mutual funds to disclose it. See, at its very core, IR or information ratio is a simple financial metric which helps investors evaluate a mutual fund's performance relative to its benchmark. Now, what sets IR apart from other metrics is that it considers the crucial element of risk. And beyond just numbers, IR is looked at as a judgment metric for a mutual fund manager's skill as well. It helps investors figure out how consistently and effectively a fund manager can beat the benchmark while also managing the risk that the fund undertakes. Think of it this way: a fund manager can have one or two good years for sure, but that tells you absolutely nothing about their skills. Because in a bull market, it is very hard to lose money even if you try. But for obvious reasons, the performance of a fund manager should be measured over a long period of time, and the information ratio is one of the helpful metrics in evaluating the skill versus luck of fund managers. So in a straightforward manner, IR shows how much extra return a mutual fund generates for every unit of additional risk it takes as compared to its benchmark index. But don't worry, if this still feels very complicated to you, let me use a very quick example to simplify it further. See, imagine two mutual fund managers. Let's call them Manager A and Manager B. Now assume that Manager A generates 30% return in a year, while Manager B delivers a 40% return. Now, at first glance, Manager B seems to be a better performer, right? But if Manager A takes on much less risk to achieve that 30%, while Manager B, on the other hand, takes in significantly more risk to achieve 40%, the story immediately flips. And that is exactly why IR matters. See, if you judge a fund only by its past returns, you may not quite get the full picture of how it will do in the future. During stable or bull markets, higher risk funds often end up doing well because momentum is on their side. But during turbulent times, those exactly same funds can get hit the hardest. Now, in case of IR, it not only looks at how much return the fund delivers, but it also talks about how efficiently those returns are generated given all the risks that are involved. Now, a higher return obviously means that a fund is better at managing this balance, and it offers more value for every unit of risk you take with your money. Now, of course, this is not the first time a mutual fund is being asked to disclose some metrics. For many years now, mutual funds have disclosed metrics like beta, alpha, Sharpe ratio, and many more, and all of them serve a specific purpose. But the thing is, none of these metrics capture both excess returns and performance consistency as effectively as the information ratio does. So by mandating daily disclosures of this particular metric, SEBI is basically aiming at giving investors a clearer and a more holistic view of a mutual fund's performance. Now in India, this is particularly very important. And that's because over here, investors usually buy mutual funds almost solely based on past returns. And as you might have probably realized by now, while returns are definitely a key part of the equation, they don't quite tell us the full story. A fund that delivers high returns but takes excessive risk may not quite be the best choice for long-term investing, and that is exactly what the IR addresses. So the next time you are evaluating active mutual funds to invest in, this information ratio metric is a very useful thing to consider. But all of that said and done, while SEBI's mandate is definitely a great step forward, the bigger challenge here will be in making this metric a standard part of how investors evaluate mutual funds. Because if people continue to focus only on high returns without considering the risk involved, the purpose of metrics like the IR and all of the mandates will pretty much be lost. You've probably seen a lot of headlines recently saying that the rupee is at an all-time low against the US dollar. Now, it almost feels alarming to read that our own currency is weakening day after day, and people are blaming the Reserve Bank of India for either not doing enough or going too far in doing too much. But in reality, there is actually a lot going on beneath the surface. So it's very important for all of us to understand how currencies work before we end up deciding whether something is good or it is bad. See, what we should understand is that modern currencies, including the rupee and the US dollar, do not have a fixed value anymore. See, several decades ago, many countries used to back their money with gold. Basically, if you held a certain amount of paper currency, the government promised to give you a specific amount of gold in exchange to that. Now, that system broke down over time, and by the early 1970s, it was completely abandoned. Now, currencies have no direct tie to anything physical at all. The rupee is worth something only and only because people believe in it and they continue to use it. And therefore, since these currencies no longer have a set value, someone who needs to exchange rupees for dollars has to rely on foreign exchange or what is called forex markets. Now, these are massive markets where people, businesses, and banks trade one currency for another one, and they set what is called an exchange rate. Now, that rate is based on demand and supply. Basically, if more people want to buy the rupee and they are willing to give away other currencies in return, its value goes up, or in other words, it appreciates. But if fewer people want it, or if more people are looking to sell rupees to buy something else like US dollars, the rupee's price goes down or it depreciates. Now, this exchange rate is very critical for almost every cross-border transaction. For example, if you're importing chocolates from the United States, you will have to convert rupees into US dollars because American sellers will only accept in US dollars. And if you're an Indian who works in the US and you want to send money home, you will have to convert your dollars into rupees. And another example is that if you're investing in American stocks from India, you will need to exchange your rupees for dollars once again. Now, millions of such exchanges happen every day, and this never-ending supply-demand sets the rupee's price in the market. And this very exchange rate that it is set at affects many people in many ways. Think of an Indian factory that makes shoes for 1000 rupees. See, if $1 was worth 80 rupees when the factory started exporting, then a pair of shoes would cost foreign customers $12.5. But as the rupee appreciates and $1 suddenly starts costing 70 rupees, the same shoes now cost more than $14, even though the factory did not change anything at all. Or if the rupee depreciates on the other hand to let's say 90 rupees per dollar, the same shoes become cheaper for foreigners and they cost only about 11 US dollars per pair. Now, this can help or hurt businesses depending on which direction the exchange rate moves. It also affects everyday life. For example, India imports most of our petrol from abroad, so when the rupee weakens, we end up paying much more at the petrol pump. Although a large chunk of foreign transactions come from genuine business needs or from personal remittances, speculators also join the game over here. Now, these people are simply betting on currencies going up or down so that they can make a profit on this. On top of that as well, central banks like the RBI play a big role here. By buying or selling rupees in huge quantities, they can pretty much influence the rupee's price. When a lot of foreign money flows into India, perhaps because investors see good opportunities over here, those investors will have to buy rupees, and that usually pushes the rupee's value up. Now, the RBI at that point in time might step in and purchase those foreign currencies like US dollar instead of allowing all of them to be converted into rupees. So this way the rupee does not rise too quickly, and when the rupee tumbles, the RBI sometimes sells its stash of foreign reserves, taking rupees out of circulation and propping its value back up. Now, in the years since COVID-19, the US dollar has been surprisingly strong against many of the world's currencies. The US economy has shown some solid growth levels, and the American labor market has been unusually tight, which means job openings are very high and unemployment is pretty low. But meanwhile, investors across the globe have been worried about putting their money in emerging markets, so they have chosen to invest heavily in the United States, which is seen as a safer bet in comparison. Now, all of that money flowing into US means that there is a higher demand for dollars, and that has made most other currencies weaker in comparison to it. Now, the rupee has gradually lost its ground as well. At one point, it touched 86.5 rupees per dollar. But if you look at other currencies, you will see that many have fallen against the dollar by much larger amounts. So in that sense, the rupee's fall isn't so dramatic when it is compared to the rest of the world. Now, one reason India's currency has not dropped so dramatically is the RBI's intervention. See, over the past year or so, the RBI has been pretty active in forex markets by buying and selling dollars to manage the rupee's value, like I just mentioned. Now, RBI has also done this before, and you will see some similar experiments from central banks across many emerging markets. But right now, RBI has stepped up its pace here after August 2022. You can see it in how the rupee dollar exchange rate was on a decline and then suddenly flattened out for a few months. Some experts say that it looks like the RBI is not letting the rupee move freely anymore and it is keeping it at a certain level. Now, this makes more people anxious in some sense. They point out that a rupee that is too strong could make Indian exporters less competitive in the market, while a rupee that is too weak could make imports like oil a lot more expensive. Either extreme could hurt the economy in a big way. Now, economists are generally of the view that prices are best set by the market, where demand and supply decide the right price for things, including currencies. If a central bank pushes the currency in a direction the market would not naturally take it, unpredictable outcomes can start following. Some analysts like Anand, Feldman, and Subramaniam have noted that the RBI's actions have made it cheaper for Indian companies to borrow money from abroad rather than from local banks because the rupee stayed at a certain level and foreign loans were more attractive. Now, as these companies start repaying those foreign loans later, it may lead to further weakening of the rupee because they will have to buy dollars to pay back whatever they owe. But on the other hand, the RBI has published its own arguments and they have explained why it has been intervening more than usual. In its view, markets do not always reflect the true underlying strengths or weaknesses of an economy. Big swings in currency prices can happen because of things like short-term investing by foreign funds, speculative hot money, or panic selling, especially in emerging markets like India, where just a small outflow or inflow can have an outsized impact on the exchange rate. The RBI points to episodes like the Asian financial crisis of 1997, where a sudden loss of confidence in Thailand's currency spiraled into a crisis across much of Asia. Now, that example shows how quickly things can go wrong if a currency starts plunging uncontrollably. The RBI is saying that it is not trying to fix the rupee's price permanently, but rather is trying to smooth out extreme ups and downs so that panic does not take over and hurt the broader economy. Now, if you're trying to understand all of this from an investor's point of view, there are a few things to keep in mind. First, it may be tempting to get worried about the news that the rupee is at a record low, but some of this decline is a part of how the global monetary system has evolved over the last half century or so. It is usually more important for a currency to set at a price which reflects genuine demand and supply rather than to artificially prop it up and push it down. The exchange rate also shapes how businesses operates, how exports and imports are priced, how foreign investors look at the country, and how everyday costs like fuel prices and so many other things change continuously. Also, finally, keep in mind that the RBI can act like a giant whale in the currency markets by buying and selling huge amounts to defend the rupees. And that is one reason you see extended periods where the exchange rate does not budge much, even if global conditions are shifting around quite a bit. But all put together, what is currently happening with the rupee is part of a complex web of global finance, local economic conditions, investor sentiment, and the RBI's attempt to keep things smooth. Understanding all of this helps cut through the daily headlines about the record lows and helps us see the bigger picture about how and why currencies exactly move. With that, let's move on to the final section of the day and talk about the quick news tidbits. First, Perplexity AI has made a surprising $50 billion offer to merge with TikTok's US operation, and they're hoping to mix TikTok's massive user base with its own AI expertise. Now, if this deal goes through, it could pretty much transform the world of digital advertising and could also help TikTok navigate all the regulatory issues while putting Perplexity AI on the map as a major disruptor in the tech industry. Second, the Competition Commission of India fined Goldman Sachs 40 lakh rupees for not disclosing its 1070 crore rupee investment in Biocon Biologics. The strategic rights attached to Goldman's investments triggered a mandatory disclosure under Indian regulations, which highlighted how crucial it is for investors to follow these rules. Well, that's all the news and stories I have for you today. I hope you enjoyed this show and maybe learned something new from it today. As usual, this is your host Anurag Bansal signing off. I will see you in the next episode. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.